Hey everyone, welcome back to Dave's Market Explorer. I'm Dave, and today we're diving into what's feeling like a classic Wall Street trap amid this escalating Iran conflict. We are at war again, and history shows that whenever chaos hits, bankers come out swinging, setting traps for retail investors while they quietly position themselves. Look, I've been through multiple conflicts in my trading years: Afghanistan, Iraq, Ukraine, October 7th, and now this. Every time, panic sells create buying opportunities, but something feels different now. Banks like JP Morgan, Standard Chartered, and Barclays are all screaming by the dip after short pullbacks of 5 to 10%. JP Morgan even called the recent decline a perfect entry point. That's unusual. Normally, they let retail panic sell while they accumulate. When they're this loud about buying, it makes me uneasy, like the 2008 playbook where Goldman allegedly sold toxic CDOs to clients while shorting them. Historical data backs quick recoveries from wars. Average S&P drawdown since World War II is about 4.7%. Bottom in 19 days. Full recovery in 42. Post 9/11, down 11.6%, then rebound fast. Ukraine 2022, 13% drop. Energy stocks up huge. But this time, retail just poured a record $49 million into the Energy Select Sector ETF in one day, chasing the obvious oil trade, while dark pools show institutions de-risking quietly. The real issue? The Fed is cornered in stagflation. Growth is slowing. Q4 2025 GDP at just 1.4%, consumer sentiment crashing to 2008 levels. Inflation sticky, core PCE at 3%, above the 2% target, and February's PPI surged 0.8% monthly, signaling more pain ahead. Then Iran disrupts the Strait of Hormuz, 20% of global oil flow. Traffic's dropped sharply, tankers attacked, insurers pulling out. Oil spiked to the dollar ADS, Brent briefly over $82. Trump stepping in with Navy escorts and insurance promises to reopen it. But if this drags, inflation spirals while growth stalls. Classic stagflation the Fed can't print out of. Rates are at 3.5 to 3.75% now. Limited room to cut without fueling inflation, and hiking would crush the economy and balloon treasury payments on $38 trillion debt. The old Volcker playbook of jacking rates to 20%? Impossible today without default risks. Adding fuel. Jerome Powell's term ends May 15th, 2026. Trump nominated Kevin Warsh in January, a former Fed governor and inflation hawk. Confirmations in process, Senate hearings likely soon. Tom Lee from Fundstrat warns markets always test a new Fed chair. In his 2026 outlook, he sees the first half feeling bearish, potential 10 to 15% corrections, volatility from the transition, AI repricing, tariffs, and this war. He calls it a wall of skepticism early on, with choppy trading until the new Fed proves itself. Once settled, post-May, he expects a dovish shift in rallies, targeting S&P around 7,700 by year-end. But until then, joy, depression, then rally. First half could be brutal. So where does that leave us? Banks yelling by the dip into war panic, stagflation risks, oil shocks, and a Fed handover test in May. It feels off, like retail's being lured in before bigger trouble. My take, I'm scaling out of overhyped AI/tech. No leverage, too risky now. Focusing on hard assets like gold and silver as hedges against inflation and debasement. They protect in uncertain times, and you don't need to nail the exact trigger. War escalation, Fed break, or chair test. Just avoid standing in the wrong spot when the music stops. This isn't financial advice. I'm not your advisor. Do your own research. Talk to pros. What do you think? Will the Fed test spark a big dip, or does Trump wrap this war fast? Drop your thoughts below. Like and subscribe for more market deep dives. See you next time on Dave's Market Explorer.